The year is 2025. The global economy is teetering on the edge of another crisis, but this time it's not subprime mortgages. It's something far bigger, far riskier, the $23 trillion US Treasury bond market. And at the center of it all are hedge funds, those secretive investment vehicles for the ultra-wealthy, making reckless bets with borrowed money. The whispers are getting louder. The Federal Reserve, America's central bank, is preparing for another bailout. And you, the average citizen, are about to foot the bill. This isn't just another Wall Street game. This is about your mortgage, your savings, your retirement. It's about the stability of the entire financial system. And it all hinges on a dangerous game of leverage and speculation, where the potential losses dwarf those of the 2008 crisis. This is the story of how we got here and what you can do to protect yourself. Hedge funds, with their insatiable appetite for risk and profit, have found a new playground, the US Treasury bond market. They're borrowing heavily, sometimes up to 20 times their own capital, to exploit tiny price discrepancies in these bonds and their corresponding futures contracts. It's a high-wire act known as basis trading, and it's incredibly lucrative when it works. But when it goes wrong, as it inevitably does, the fallout can be catastrophic. Right now, these bets are turning sour. Hedge funds have trillions of dollars riding on these trades, and they're starting to lose big. As losses mount, lenders are demanding more collateral. To meet these margin calls, hedge funds are being forced to sell their treasury bonds, flooding the market and driving down prices. This creates a vicious cycle of selling, further depressing prices, and triggering more margin calls. The situation is spiraling out of control. What makes the situation particularly alarming is that it's not just stocks taking a hit. Bonds, traditionally seen as a safe haven during market downturns, are being sold off at an unprecedented rate. This is a clear sign of panic in the markets. Investors are dumping everything, even the supposedly risk-free assets. We haven't seen this level of fear and uncertainty since the darkest days of 2008, but this time the stakes are even higher. The 2008 crisis was triggered by subprime mortgages, a relatively small part of the financial system. This time the epicenter is the US Treasury market, the bedrock of the global financial system. If this market collapses, the consequences will be far more widespread and devastating. We're talking about a potential global financial meltdown that could make 2008 look like a minor blip. The situation is further exacerbated by the actions of major financial institutions. These institutions, sensing blood in the water, are pulling back lending to hedge funds and demanding more collateral on existing loans. This is like cutting off a wounded animal's escape route. Hedge funds, starved for cash, are forced to sell even more assets, further depressing prices and accelerating the downward spiral. This is what's known as a liquidity crisis. It's like a run on the bank, but instead of depositors withdrawing cash, it's financial institutions pulling back funding. As liquidity dries up, even healthy businesses can find themselves unable to secure the financing they need to operate. This can lead to a cascade of failures, spreading panic and paralysis throughout the financial system. This is precisely the scenario that played out in 2008, and it's a scenario that's rapidly unfolding once again.